Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So I want you to imagine waking up to find that the interest rate on your new mortgage in Ohio, or maybe your car loan in Texas, was just driven completely through the roof by a handful of currency traders operating, thousands of miles away in Tokyo.
Right. It sounds totally like a conspiracy theory, honestly.
It really does, but it's actually just the hidden reality of global financial plumbing. And according to recent data, in late July and early August of 2026, the United States and Japan quietly executed this massive, historically rare joint intervention in the foreign exchange markets. I mean, they basically teamed up to buy staggering amounts of Japanese yen.
Yeah. And the scale of this move, I mean, it really can't be overstated. You have to go all the way back to 2011, right after the Fukushima disaster, to find the last time Washington and Tokyo officially linked arms to intervene like this.
Wow, so it's been over a decade.
Exactly. And the context here is just severe. The Japanese yen hadn't just been sliding, it was in a structural freefall. By late July 2026, the exchange rate crashed to a 40-year low.
A 40-year low, which was what, like 164 yen to a single US dollar?
Yeah, roughly 164. And then suddenly this coordinated wave of central bank buying hits the market. It just violently dragged the exchange rate down into the 156 range. Looking at the latest data from August 5th, it stabilized around 157.6.
Right, and that level of sudden stabilization, I mean, that doesn't just happen organically. It takes a tremendous amount of capital. So for you listening today, that's exactly what we're going to explore in this deep dive.
It's a fascinating topic because the mechanics behind it are just so interconnected.
Yeah, completely. We're looking at this specific intervention to answer basically three core questions. Why did the yen experience such a catastrophic collapse? Why would the U.S. government, under the current Trump administration, authorize billions of dollars to, bail out a foreign currency?
Right. Why do we care?
Exactly. Why does America care? And most importantly, we want to look at how a currency crisis in Asia secretly ties directly to the U.S. Treasury market and ultimately straight to your wallet.
Well, to understand those linkages, we really have to look at the root cause of the yen's collapse.
Yeah.
It wasn't a sudden crisis of confidence in the Japanese economy itself.
Okay, so what was it then?
It was basically the gravitational pull of interest rates, specifically the massive interest rate gap between the United States and Japan. You see, capital is, it's inherently agnostic. It just flows wherever it gets treated best.
Right, wherever it can make the most money with the lowest risk.
Exactly.
So let's break this down with a simple analogy for everyone. Imagine two banks on the exact same street. Bank A is the US, and it pays you a really high return on your savings. Bank B is Japan, and it pays you almost nothing.
That's a perfect way to look at it.
So naturally, investors are just going to borrow super cheap money from Bank B, walk across the street, and deposit it into Bank A to get that high return. In finance, this is what they call a carry trade, right?
Yeah. That's the carry trade in a nutshell. And for those who track the markets, the yen carry trade is basically a permanent fixture. But the mechanics are just so powerful when the gap is this wide.
Right, because an institutional fund can borrow billions of Japanese yen since the cost to borrow is practically zero.
Yep. And then they immediately sell that yen to buy U.S. dollars. They take those dollars, park them in U.S. treasuries or other American assets paying higher interest, and just pocket the difference.
But the danger isn't just one guy doing this trade, it's the sheer volume of it.
Exactly. When every major hedge fund is constantly borrowing and dumping the yen to buy the dollar, they flood the open market with yen. It's basic supply and demand.
Because when the market is flooded with a massive surplus of something, its value drops.
Right, the yen loses value, which forced the Bank of Japan into a really tight corner. On July 31st, recent analysis shows the BOJ actually raised their policy rate to 1.0%.
Which is a huge move for Japan historically, right?
Well, massive. But in the grand scheme of things, U.S. rates are still significantly higher. A 1.0% rate in Japan just isn't enough of a deterrent to stop the carry trade when U.S. yields offer such a huge premium.
The math still says, bet against the yen. But I have to push back here. If the underlying disease is this big interest rate gap, and the Bank of Japan's hike wasn't enough to fix it, is buying a bunch of yen just a temporary Band-Aid?
Well, that's the big question the market was trying to figure out. If they were trying to permanently reverse gravity, you'd be right. It would be totally futile.
Like trying to stop a tidal wave with a bucket.
Exactly. But they aren't trying to fix the underlying economics permanently with this move. The goal was actually a highly calculated psychological operation.
Wait, really?
Uh,
A psychological operation?
yeah, the goal was to punish speculators and drastically increase the cost of betting against the currency.
Oh, I see. So it's kind of like a speed camera on a highway. The government doesn't actually need to physically pull over and stop every single speeding car, which are the hedge funds shouldering the yen.
That's a great analogy, yeah.
They just need to set up a massive, highly visible speed trap. Suddenly, the financial cost of getting caught speeding just isn't worth the risk anymore.
Exactly. It's basically a weaponized short squeeze.
Yeah.
The central banks know these funds are heavily shorting the yen,
Yeah.
so they step in unannounced, buy massive blocks of yen, and force the price to violently spike.
Which means those hedge funds suddenly get margin calls. They're forced to buy yen at a loss to cover their bets, which actually drives the price up even more.
Right. The speculators end up doing the central bank's work for them. It completely alters the risk calculus.
Yeah.
For months, shorting the yen was viewed as a totally risk-free bet.
Not anymore.
Definitely not. And some critics say the intervention failed because the yen bounced from 156 back to 157.6.
Mm.
But the data shows the yen is still about 4% stronger than before they stepped in.
And in a multi-trillion-dollar market, a 4% stabilization is huge.
It's a massive structural shift.
Yeah.
But more importantly, it bought the Bank of Japan time. If the yen had kept plummeting past 164, Japan might have had to panic.
Like they would have had to aggressively hike rates just to defend the currency.
Yeah, they might have had to jump to 2 or 3% overnight, which would have absolutely crushed their own domestic economy.
Right.
A disorderly rate hike is a central banker's worst nightmare.
Right. It freezes lending, shocks the housing market, everything. So setting up this speed trap bought Japan time. But here's the plot twist and why this matters for the American listener. Why did the U.S. decide to help pay for the radar guns?
That is the million-dollar question.
Because recent analysis brought up a really shocking detail. U.S. Treasury Secretary Scott Bessent, under the Trump administration, was noted in a memo reviewing a $5 to $10 billion yen purchase.
Yeah, and the New York Fed actually sold euros to buy yen on behalf of the U.S.
So why is American capital being used to fix a Japanese currency problem?
Because it's really an issue of self-defense. It's about protecting the American bond market. See, Japan is the single largest foreign holder of U.S. national debt.
Wow, really? The largest?
Yeah, according to the data from May 2026, Japan owns about $1.14 trillion in U.S. treasuries.
That is a staggering amount of leverage.
It is. So think about what happens if the U.S. refuses to help, and Japan is left all alone to fight off these speculators. Japan would need hundreds of billions of U.S. dollars in cash to keep buying up their own currency.
Right, and to get that cash, let me guess. It's like if your roommate is about to go bankrupt and the only way they can get cash is by selling the car you both share, you're going to step in to stop them.
Exactly. Japan would have been forced to execute this massive fire sale of their U.S. Treasury bonds on the open market. They'd have to dump their dollar reserves.
And this is where it hits the American consumer directly. We need to explain this underlying bond math because this is how Tokyo hits Texas.
Yeah.
There's an inverse rule with bonds, right?
Right. When the price of a bond falls, its yield, or the interest rate it pays out, has to go up.
So if Japan suddenly floods the open market with hundreds of billions of dollars of U.S. treasuries, the immense supply just crushes the price of those bonds.
Exactly. The price tanks, which means U.S. Treasury yields mathematically have to spike. And those Treasury yields act as the foundational benchmark for consumer credit here in the United States.
So if Japan dumps bonds, U.S. yields spike, and instantly American mortgage rates go up, car loan rates go up.
Yes, credit card rates, corporate borrowing, even the cost for the U.S. government to finance its own deficit becomes astronomically more expensive.
So the U.S. basically intervened to protect the American bond market from a Japanese fire sale.
Exactly. They treated a symptom in Tokyo to prevent a mortgage shock in the U.S.
That is wild. But wait, that creates a mechanical problem. Japan still needed billions of U.S. dollars in cash to execute this short squeeze against the hedge funds.
Right. They needed the liquidity.
But Washington knew that if Japan sold their U.S. bonds to get that cash, the American bond market would crash. So how do they get the cash without actually selling the bonds?
This is where we get into some really clever financial plumbing. They used a specialized loophole called the FEMA repo facility.
FEMA. That stands for Foreign and International Monetary Authorities, right?
Yep. It's a liquidity window created by the Federal Reserve. It is the absolute linchpin of this entire operation.
So for anyone who doesn't read Fed balance sheets for fun, let's translate this. A repo facility is basically a high-end VIP pawn shop run by the Federal Reserve.
That is exactly what it is.
Instead of Japan holding a garage sale and dumping their U.S. bonds on the open market, which crashes the price, they take those bonds to the Fed pawn shop.
Right. They walk up to the Fed window, hand over their treasuries as collateral, and the Fed gives them a massive short-term cash loan of newly printed U.S. dollars.
And then Japan takes those dollars, goes out into the currency market, and buys yen to squeeze the speculator.
Exactly. And the genius of FEMA is that the bond market is completely untouched. Since the bonds were just used as collateral behind closed doors at the Fed, they never hit the open market.
So there's no supply flood. U.S. bond prices don't crash, interest rates don't spike, and the American homebuyer is totally shielded from the drama.
Right. And eventually Japan just repays the cash loan and gets their collateral back. But it also does something else. It gives Japan a massive amount of ammunition.
Because suddenly, speculators aren't just fighting Japan's checking account.
Exactly. They are fighting the total sum of Japan's sovereign wealth backed by the printing power of the U.S. Federal Reserve. It totally shatters the confidence of anyone trying to short the yen.
That is a brilliant defensive mechanism. But, we have to connect this back to segment one. FEMA is just a pawn shop loan. It doesn't actually fix the underlying interest rate gap.
No, it doesn't at all. It gives both countries a really strong safety net. But the Bank of Japan's rate is still 1.0%, and U.S. rates are still much higher.
Right. The incentive for the carry trade is still sitting right there.
Precisely. FEMA is not a cure. It's just a heavily fortified holding pattern. It buys them time while they wait for inflation and economic growth to shift naturally so they can adjust rates the normal way without crashing the system.
So it's basically a managed runway for a soft landing. What started as an obscure foreign headline about the yen really reveals this deeply interconnected web.
It really does. Everything is tied together.
A currency crisis in Tokyo literally could have meant higher mortgage rates for you here in the U.S., but clever mechanics like this FEMA pawn shop helped manage the risk.
Which is great for today, but it does leave us with a pretty lingering, provocative thought for the future.
Oh, what's that?
Well, the precedent has now been set. The U.S. was willing to directly intervene in foreign currency markets and act as a pawn shop to protect its own debt market. So what happens if another major global ally faces a similar sovereign crisis?
Does the U.S. just become the permanent backstop for the world's currencies?
Exactly. If the U.S. balance sheet has to constantly absorb global volatility to protect our bonds, what does that ultimately mean for the strength and stability of the U.S. dollar itself in the long run?
Wow, that is a precarious balancing act to think about. We're definitely going to have to keep an eye on that. Don't forget to subscribe and hit that like button.